Joining us with a preview, Scott Siefers, senior research analyst over at Piper Sandler. Scott, great to have you with us. When you take a look at how the KRE trades, it's basically trading at the low levels since the banking crisis began. Is there reason for that? Is there another shoe to drop?
Question. It kind of feels to me like, things have certainly calmed down a bit since a few weeks ago, and that's good. Unfortunately, it's going to be a long road ahead. Hopefully that initial shock has passed, but, maybe we're starting to get past that. With earnings starting tomorrow, we'll finally get our first glimpse into how individual companies have fared and bolstered their balance sheets since the onset of all this turmoil last month. So, hopefully that'll reintroduce some confidence back into the system. But again, there are going to be, in all likelihood, a lot of changes here that could be sort of long lasting. They'll have impacts on growth, on profitability, et cetera. So it's going to be a long road.
Bolstering their balance sheets and keeping deposits in-house or bolstering deposits, that all sounds like expensive propositions in general for banks. So which banks have the biggest question marks over them in your view?
Yeah, so, the good news is that when we start the earnings season tomorrow, we'll probably start on a high note with some of these big banks like JP Morgan. So maybe I'll sort of reframe the question and go with the safer havens. A big name like JP Morgan, which we've liked for quite a while, that'll likely be a net beneficiary of all this turmoil, having been probably upstreamed a lot of customers and deposits. So, we'll be watching those numbers really closely here over the next couple of days. It gets a little probably choppier as we get later into the earnings season and we get some of the smaller banks that investors will be trying to figure out. How much have we been able to keep from our deposit base, and what's the cost to doing so?
For a firm like JP Morgan that gained deposits, though, Scott, keeping those deposits could be costly. It could erode margins. Do they want to keep those deposits? And didn't this show people that it's really easy to move money around? So they might move to JP Morgan initially, but then move it to treasuries or elsewhere.
Yep, undoubtedly. So I don't think JP Morgan or B of A or Citi or Wells Fargo are Pollyannish enough to believe that the money that flowed in over the last several weeks is necessarily permanent. So they probably believe that things have moved for safety. Now they'll likely move for price later on. So, I doubt that, JP Morgan is out there saying, look, we've got this massive inflow of deposits. We have to go make a bunch of new loans with that. Rather, I think what they'll try to do is keep at least some percentage of that new money and those new customers as permanent ones. But by no means do they think that that's going to be permanent money in totality. In a sense, you could almost say that cohort of the largest banks is acting a bit like a kind of an exo central bank at this point. But, if I were one of those management teams, I would want to keep as many of the customers as I could. And, I think one other factor is that for those largest banks, customers moved to them on the perception of safety. So it's quite possible that the largest banks could actually have a pricing advantage going forward, insofar as customers think, hey, the price for safety is going to be that I'm not going to be paid as much as at other institutions.